Well, that's if it's a foreclosure. So we're not getting foreclosures. See?
No, no, it's not getting foreclosure.
Hmm.
If we get that property before it's foreclosed,
Hmm.
then we say to the let's say we say to the uh rent to own.
Hmm.
So the rent to own
Hmm.
actually get the property.
Right. So
Uh,
if we get the property, right, from the homeowner, like you said,
mhm.
before the foreclosure, and we put on the rent to own, the state does not get anything. They cannot because it didn't
Okay.
foreclose. So that law that you're
Yeah.
talking about
I
doesn't
mean,
apply to them. Right.
fortunately, the rent to own,
Hmm.
the guy from the land to own get the
Hmm.
property. He pay all the money all the way in. So it's rare, but what we do if the renter get the property.
Well, the renter can only get the property if we sell it to them.
Yeah,
Yeah.
but we sign the contract. We sign the agreement to
Right.
sell the property you know if he has the money. So he show the money, and we have you know we have to sell the property to the when rent to own renter.
Right.
So what will we do if he buy it?
If the renter buys it,
Yeah,
we sell it to them. We don't do anything. The state doesn't get any
but
money.
state will get 20%
The
and
state
hide
only
it.
gets 20% if it's a foreclosure.
No, state will get 20% of equity of the property,
Right.
no matter what.
If it's in foreclosure, the state can.
No, 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 not even the foreclosure.
So you're
Whatever. If
telling
you
me
sell it
that
to
if
the
someone sells a property in California, that's what you're telling me, right?
yeah.
That the state is going to automatically get 20%.
No, 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 not someone sell in the property. I mean, so right now the HEFA program, where the state will provide 20% down. And
Mhm.
I mean California Dream for All program. State will let's say I'm
Oh yeah,
buyer.
and that's if you go through the state sponsored program. So we don't do that. We don't go through that. We're doing a private transaction between us and the tenant buyer. So we won't get involved in that because I don't want the state taking my 20%. I've sold properties in California before, and they never did that because
No, no.
property.
So let's say we are taking the property
Mhm.
from the people who borrow the money from the. I mean, who get the money from the state. So what will we do? How will we do? That's my question.
We would did it the same way. It was
Yeah,
still the deed was
but
still
state
transferred the
stay
same way.
stay entitled 20% of the cat. Even you sold it, or even you, I don't know, you rent it,
Mhm.
but even you sold it, and even you foreclose.
Yeah.
That's what I mean.
Send that information to me, Zarni. Let me take a look at it, and I'll tell you a little bit more about it. Okay.
Okay,
You
sure.
can
I
email
send you.
that to me. That would be fantabulous because now we have to move on to this.
Yeah, because that's a new news, and I don't really know how to deal with that.
Yeah. Well, if you find the article, just send it to me. I'll look it up as well. But we have to move on right now at this
Okay,
point.
sure. Thank you.
Okay, thank you for that. But that's good information. I'll definitely look that up. All right, folks. Good evening. Welcome to session number 1 of 14. And of course, this session is going to be basically a Q&A. All right, we do this on purpose because we want to get everything out there. We want you to ask all the questions that you have about this particular strategy. How do you think it works? How do you think it won't work? This, that, and the other. So we're going to discuss that because we like to do it that way rather than flood you with information and documents and you don't have the theory down pack on lock. So that's how we do this. And session number 2 will be partly that too, but we get right into marketing in session number 2. So with that said, we're going to formally start this session and it's recording right now. We record every single session for you, just in case you miss a session because of work, domestic, time zone issues, or whatever the case may be. So you will get a recording of this in your email box the very next day. And if you don't make the live session, and if you do make the live session, you'll still get it again. So we want to make sure you get this. See, we don't want you to miss anything. We really are trying to build a solid network across the country. You're in Arizona and all the other states. So that's why we do this like this. We allow you to take the course. If you pay for the course, you can take it over and over and over again the next 14 sessions at no additional costs. All right, because we want to make sure you got it. You have the option of taking all 14 again, or whatever you think you need to brush up in. So this is what we do. We're sincerely, honestly interested in your success. All right. So this is a Q&A. Some of you have taken the class before that have been here, so you understand how this works. We have a lot of people. I think we have 22 people that are on this session. Some of them couldn't make it, of course, because of work, domestic or whatever, but we are recording the session for them. So during subsequent sessions, you'll see different people come on and off here, and that's what it is. They'll be able to pop on at their leisure or discretion. All right. So with that said, before we start, and thank you for that information, Zarni. That's good info. I'm definitely going to look that up to see how that works. Okay. But as I was saying, how traditionally foreclosures happen, just in case you guys didn't know, there's another cash cow for foreclosures. Let me tell you how this works. In almost every single state in the country, if a house forecloses, right, that means the bank takes it back and they sell it on the market, and they sell it for more than what the original homeowner owed on it. That's called excess funds, right? What the state does is the state holds that excess funds. What the state is supposed to do, and they do not do, is they're supposed to notify the homeowner who had the foreclosure and say, hey, guess what? We know you had a foreclosure, you couldn't stop it. It was auctioned off and it sold for more than what you owed. This is the excess funds, come and get it, right? They don't do that here, and they don't do that in a couple of other states. I know the states leave the money there. They're supposed to notify you. They keep it for 2 years, and they claim they did notify you. And after 2 years, which means 48 months, they take that money and they put it back into the state's coffers. That's how they get extra money. Boom, number one. So number two, if you know about this, right? Let me tell you, because I used to do it. If you know about this, you can find out when the particular auctions for certain properties are going to take place, because it's public record. Oh, auction will take place, boom, 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 right? And if you find out that a property has sold for more than what it's worth, right? What I used to do is contact the former homeowner, wait, a little bit, and say, hey, I see your property foreclosed. So sorry to hear about that. How's everything going? Oh, everything's terrible. I'm still living here, that and the other with mom, or apartment, and just down. I said, I'll tell you what, if I can get some money for you for your foreclosure, would that interest you? Everybody's going to say yes. Everybody has always said yes. And what I do, I make a deal with them that I can get them X amount of funds, right? For, actually the funds that I make a deal with are the excess funds that the state is holding. And then I just charge a percent of it. It's a good business. It's a very, very good business if you know how to do it. It's called excess funds. If anybody's interested, that information and that training, which is very little training, it's not big, but the information how to do it, you can probably Google it if you can, and maybe find a way to do it in your state. I'm not sure. But if you don't know, we give that extra information for people who join the elite team, the elite membership. You get that information, you get that kind of training. So that way, that's the extra cash cow. Let me tell you, it works all the time. People will pay, we'll show you how to get paid too, rather than somebody telling you they're going to pay you the money on a promissory and then they don't pay you, but there's ways to do that. But I just wanted to throw that in there since he brought up the foreclosures and the excess funds. I thought I'd drop that to you. So been doing this for 20 years. That's why we know how it works. All right. With that said, let's see, we've got Tila. How you doing today, Tila? And then we've got Constance, of course, our co-host. And we got Anthony, and we've got Carl, we've got Zarni, who just spoke a while ago, and we got James. Carl, how you doing? You're new to the forum here. Good to see you, sir.
Good.
Right.
Likewise.
Excellent. Glad you can join us. Glad
to be here.
Hey,
Yes, ma'am. Tila, how you doing? I see you they're freezing a little bit. When I say freezing,
Yes.
the camera just froze. I don't know.
Oh wow, that sucks.
But now you're good. You're good.
Yeah, I'm gonna leave class early because I gotta get back to work, but I'm gonna join for now.
Fine. And that's fine. We're just glad you showed up. Remember, we're recording this anyway, so anything that you do miss, that you'll be able to watch it later on. And of course, the benefit of showing up live is so that you can ask questions, okay, and hear the answers and whatnot, all right? Because obviously, when you watch a video, you might go, oh, wow, I have a question, but you can't question the video. So we want you to do the live thing when you can. So no worries there, all right? So we're going to get right into the class. And before we begin, I want to ask anyone, how you doing there, James? I see you there.
Doing good. How about yourself?
Really good, really good.
Glad to be
You're
here.
in California too. Have you heard that?
No, I haven't heard it.
Yeah, so I'm going to look that up. That's pretty interesting. But I do not think that it does apply to us, but I'm going to find out because state legislature and laws change all the time in states. And California is doing some funky things right now. as far as I know, they still enacted, or they just recently enacted the rental moratorium. So
Mhm.
you cannot even evict tenants out, which is, and that's statewide. Remember, it was a federal thing. So
Yeah.
states are allowed now to go ahead and do these things. So what Zarni said may be actually true. We're going to find out if it affects us, though. I'm not saying what he's saying is not true, but I'm saying see if it affects us, because we're always looking and learning and trying to find out what we can do, particularly for you guys out there in California. So we'll look that up, Zarni. Definitely look that up. And you too, James, and all those other people that are California natives and are going to be getting these properties in California. All right. So give me a second here. You know me, I'm old man here. Trying to pull up my screen and make everything happen here. But take notes. And remember, this is basically a Q&A session. The other subsequent sessions that are coming up, you're going to get a lot of information. We're going to send you documents. We're going to send you forms. We're going to send you things that you can use, that you can train on. With each session, you'll get those at the bottom of the session. It's recommended that you download them to your desktop, your laptop, so you have them for your records. And these are going to be training documents. When I say training documents, means they're going to be in a little square around the box, around the whole document. Might have some yellow notation. So don't worry about that. You can write on them as much as you want, download them, print them up, use them, put your notes on them. That's what I would do. At the end of session 14, when the 14 sessions are over, I and Constance, we will send you a complete set of documents that'll be in Word format, so you can tailor it as you please. So you get a complete set anyway, don't worry about it, but take plenty of notes and download what we give you, okay? This is a great session. Again, this strategy is called subject to, and it's short for subject to the existing mortgage. What does that mean? Is that you take over a property, right, with the existing mortgage in place, which is different from a traditional acquisition of a house. Traditional acquisition, okay, we find a house down the street we love. Oh my God, it's a nice house. It's for sale. So I'm going to get a realtor, I'm going to call her. She's going to, find out who the owner is, or I'll find out who the owner is. And we write up a contract, right? And we write up a contract. I get, a mortgage broker or a lender or bank to go ahead and give me the money, this, that, and the other. And boom, the sale is done. And what happens is that the existing mortgage that the homeowner had is paid off completely, doesn't come with the house. The new mortgage that I got is now on the house with the deed. That's a traditional sale. We don't do that. That's traditional acquisition. To do that, you got to put your credit on the line. You got to have a nice FICO score. You got to have that hefty down payment, and you got to qualify. Okay, so we don't do nothing like that. Not to say that you should not, because I know investors personally, when they purchase houses to rent, to own, or even to rent out, that's what they do. They put their credit on the line, put 10, 20, 30,000 down, get the house, it's theirs, the deed's in their name, they have a mortgage, and they rent it out or rent to own and make some money. However, with that strategy, which is great, you are only allowed to actually get X amount of houses on your credit, maybe 2 or 3 at the most, because your debt to income ratio, you can only get a certain amount of houses that a lender will keep giving you loans for, right? Not so with subject to. With subject to, you don't have to worry about that. You could have 10 houses, 20 houses, 30, 40, or 46 like we had during the last ones. All right. All of them we had the deed to, but since the mortgages were not in our name, we didn't have to qualify for anything because the mortgage already came with the property. So that's the beauty about subject to. You can get as many houses as you want. You don't have to worry about your credit. There's no cap on what you can own or whatever the case may be. The beauty about it is that even though the mortgage is no longer, even though the mortgage is not in your name, it's still in the homeowner's name. You're like, well, why would I pay a mortgage in someone else's name? Isn't that building up their credit? Yes, it certainly is. But this is not about credit. This is about you getting the property, right? Which you get the deed, which makes you the owner, and you make the money off of the property. That's what this is about. Okay, you make cash. The former owner cannot get another loan because they're no longer attached to the deed. They cannot refinance. They cannot get no cash out. They cannot do anything. They're disattached from the house. The only thing that they have attached to the property is that the mortgage, the original mortgage that comes with the house when they give it to us, is still in their name. So we're paying that and we're helping their credit. Okay, we're saving their credit. We're stopping their foreclosure. In return, In return for doing that, what do? We ask them to give us the deed to the property, because I'm going to tell every homeowner, and you should too. Sure, I'll stop your foreclosure. I'll save your credit and make the payments, but I'm not going to do that if I don't own this house. Okay, so we're not going to be doing you a favor and make the payments and save your credit and give you the deed and you move on. No, in return for that, we get the deed. And the reason why we want to do that is because the original reason why you're in this situation and why you call us is because you can't make the payments, right? You cannot take care of the house. You can't do the maintenance. This is beyond your scope. You lost your job. You lost your income. So many different reasons. So you would not be able to carry through with the original intention of paying the mortgage and staying in the house. So rather than foreclosing, right? And okay, great. Rather than foreclosing and having that on your credit, we stop in, we save your credit, we stop the foreclosure, we get the deed, and you move on. Other investors who teach this strategy that I'm talking about, what they do is they approach homeowners in foreclosure the same way that we do, right? Except they're giving them cash. They're like, here you go, I know you're in foreclosure, I'm gonna save your credit, you give me a deed, we move on, whatever. I'm just nutshelling it, right? And they give them money, 5,000 to move, 10,000, 20,000, their equity and stuff. We don't do that because we believe if we are stopping your foreclosure, which means on your credit report, it's not gonna say that for 10 years, right? It's not gonna be a stain, right? And if you have missed the back payments, that means your credit dropped down to 500 or whatever the case may be. We start making the payments, that means your credit is going to go back up and maintain a steady level. We're helping you. Technically, you should be paying us, right? Because we're doing a service. So that's how I teach you to approach people. I teach you to approach people. You don't give them cash for their houses like these other investors do. You do not do that, okay? You approach them as a service. I'm doing you a service. I'm helping you. I'm going to stop your foreclosure. You're not going to have this $400,000 debt on your record for 10 years. All right. Matter of fact, I'm going to pay it every single month until we can sell the property. That means it's going to be out of your name and your credit is going to be immaculate. You know, your credit is going to be great, this, that, and the other. For that, you have to give us the deed to the house. Okay. And that's what we teach you to do. The other guys, they give cash. I've been to some of these real estate meetups, and I've talked to a lot of these guys at Starbucks who are investors like me, and they're talking about their little war stories. Well, I did this, and this homeowner, they needed to stop their foreclosure, and I saved their credit. They gave me the deed, and I gave them 5,000. I gave them 10. I gave them 2. Eric, how much did you give? And I'm like looking at them because I was trained different. I'm like, you gave them money? I'm like, I didn't know you had to do that. And they were shocked, and they couldn't believe that every single house, and I'm telling you, without fail, every single house we took over the years, over 20 years, 2001 crash, 2008, 2013, we never gave the homeowner cash for the property, okay? They were happy that we stepped in because they exhausted every other option. And this is what we're gonna teach you to do, all right? They're gonna exhaust every option, which means we asked them, did you speak to your lender? Oh yeah, I sure did. And they said, I just got to come up with the back payment, so I'm going to foreclose. Did you try to get a loan? Yes, I tried to do that. My credit's not good. Uncle John couldn't give me the loan. I tried to go to the casino, didn't happen. I tried to win whatever they tried, you know, it didn't work. And the last resort is us. It's either us or foreclosure. So you wonder, you scratch your head and say, well, this is a new strategy. Sounds interesting. I never heard this, but a person would actually give you the keys, right? They would give you the keys to their house, right? And then sign the deed over to the house. You own the house and they walk away. Yes, they would do that. They would do that to stop that $400,000 debt from staying on their credit for 10 years. And they have nothing. They have nothing. Remember, we're saving their credit. We're making the payments, right? After that house is sold years down the road by us, who gets all the proceeds, that homeowner is going to benefit because that's going to be off their record in good standing. They can buy another home again. Again, should be paying us. This is why we do not pay them. Everyone understands that?
Yes. Wow.
Yes. So this is what I'm going to teach you. And you guys should go to YouTube. YouTube, Google it. These guys who teach substitute, listen to them. Listen to them pitch, listen to their pitch, and listen to the final thing. They pay for these houses. They pay for them every day, and we don't. Now, you may say, well, Eric, you say that, blah, blah, blah. What proof? Let me tell you, I've saved a lot of my contracts from back in the day and some of the recent ones, and I'll show you them, actual contracts with the homeowner's signature, and you'll see earnest money will either be $1 or $10 or sometimes zero, and cash paid to seller will always be zero. And they give us the house and they thank us and walk away. Because remember, I'm going to teach you guys to present yourself as a service company helping people stop their foreclosure, not as investors saying, hey, we'll buy your house for cash and we'll help you out. Those guys are messing up the game, I'm gonna tell you, because what they do, they put in the mind of the homeowner who's already in financial straits, who already knows he's got to move, who's already knows he has a foreclosure coming, right? They put in their mind, oh, I can get cash out of this deal. No, why would you get cash and we're making the payments? Why would you get cash and we're saving your credit? Wait a minute, hold on, you got this thing backwards. So you guys got this? I know I'm repeating myself, but I'm trying to drive the point home. Now, with that said, you will come across some fabulous properties, because the beauty about this strategy is that we don't drive for broken down houses. We don't drive for dilapidated houses. We don't look for houses that are broken up and try to get a deal. The houses that you're primarily, most of the time, are gonna get are houses that what we call turnkey. Don't even need a coat of paint. Don't even need no carpet change, nothing like that. These people just realize, my God, I can't make the payments anymore, or I don't want to make the payments anymore. Okay. So that's what happens. So we're helping people, we're serving people. And that's what I'm going to teach you how to do. I do not teach you to pay for anything. Now, back to my other point. You will run across a fantastic deal. You may run across a mansion. You may run across a 7-bedroom, 9-bedroom house, right? 5-car garage, 2 acres, what? And they're in foreclosure too. And they do subject to. So I'm saying when you run across that, perhaps it may be intelligent to give the homeowner some cash to do that, because you're getting extreme value. So I'm not saying don't do that, folks. I'm saying how we're going to train you and teach you is not to give cash. And if cash has to be given, you're going to make the decision if it's worth that for you. But again, this is the true no cash down to the homeowner strategy. All right. I just want to get that out of the way. Okay. I want to get that out of the way. Anybody have any questions for me? Come on, talk to me. Don't be scared. All right. So subject to the existing mortgage, what exactly is it? Now, there is a certain, and look, guys, when I'm talking, please, any questions that pop up in your head and anything I'm saying, interrupt me. You're not rude. Okay, interrupt me, because I tend to keep going on and on and on. I may not hear you, but say, Eric, I have a question. Say it loud. I'll stop and answer your question. All right. So,
Okay, I got a quick question.
yes, sir. Go right ahead.
I know you were mentioning, like, you know, if you come on a deal that's like a, I don't know, mansion or kind of expensive piece of property. Now won't the bills be more like the, you know, because we're supposed to take over the subject to existing loan, you know, won't that be a little intimidating? Like, wow, how am I going to afford that much?
Yeah, you're absolutely right. This is Anthony, right?
Carl.
Yeah, Carl. Sorry, Carl. Yeah, you're absolutely right. So what we do is that I'm not going to tell you to take a property that is too much for you. You're going to make that decision, Carl, if that's a good deal for you. So what we're going to talk about during the sessions that are upcoming, because we get to that point that you're talking about, we're going to show you what's a good home to take over and what's not. And what you're going to have to determine is what you can get for the rental rate versus what it costs to keep that property. So let me tell you in a different way. So what it means is that, let's say, for example, this is just an example. You run across a house and the homeowner's like, yes, thank you so much. I know your program. I like this. I'll sign everything, give you the deed, walk away, whatever. And their mortgage is, let's say, $3,000 a month. Let's just use that number, right? That's what they have to pay every month to the mortgage company, right? In order to maintain the standard, right?
Is that you mean like PITI?
Right, PITI, that's property, insurance, taxes, everything in one, right? So let's say it's I'm just using that number. It could be higher, it could be 5,000, whatever. I'm just using that number to drive home a point. So let's say it's 3,000 a month, right? You have to determine if that property is going to be worth for you to take. So what we teach you to do is that you have to find out what the going rental rate in that area is. So if the mortgage is $3,000 a month, right? And you find out that you can only rent that property for $2,500 a month, because that's the rental rate for that 3-bedroom, 2-bath that you just took over, right? Then obviously that's not a good deal, because you have to come out of your pocket $500 to make up the mortgage amount, and there's no money for you, you know, over that, right? So for a $3,000 mortgage, you have to make a minimum of $3,300, $3,500 for rent. That way you can cover a couple of hundred in your pocket every single month, and you can pay that mortgage. So the same thing would happen if you get one of those great deals that we're talking about, Taj Mahal type of thing, mansion, who knows, right? So there are people who like those properties. Now you got to remember, if someone took out a mortgage against a property that's got 9 bedrooms, 5 garages and whatever, they can make those payments, right? There's people who rent those too. There's people who make those rental payments for those kind of properties as well. So that's the kind of person you're going to market to. However, before you decide to take the property, Carl, we teach you to make sure that the spread between what you have to pay on your mortgage and what you can get for rent makes sense. If it doesn't, obviously, you're going to turn that down. It'll be a negative situation. Okay.
Okay. I was just thinking, like, I see what you're saying, and I understand what you're saying, but my only concern was like, you know, the time it takes to find that tenant or whatever, the tenant buyer or whatever.
Good
you know,
question.
like, you know what I mean? Like, I don't know, a month or 2 or whatever. You
Good
still might
question.
have to
That's
pay.
an excellent question. I like that question because that's a real good one. Let me tell you. So what the other guys do who teach this, right? You get the property from the homeowner, right? You get it, you got the deed, you lock it. Now I'm gonna go market and get somebody in that property. But guess what? The mortgages do, right?
Right.
What if it takes you 2 months, like you said, to get somebody in there, right? So we don't teach you to do that. We don't teach you to do that. As soon as you talk to the homeowner and you ascertain this is a good deal by the numbers, and we talk to the lender, because you're going to do that within a couple of days, right? And then you have the homeowner sign a contract. The contract means that the closing date is still 30 days out or 45 days out, right? So you have them sign the contract. As soon as my homeowner signs the contract, let's say I talked to him last Thursday and he said, yeah, come by, I see the house, everything. We make the deal. We go through the rigmarole and he signs the contract, right? And I know I got 30 days to close, and we signed today, which is April the 8th. Guess what I'm doing tomorrow? I'm marketing that house out to my tenant buyers right now. So by the time me and the homeowner close 30 days from now, I got a tenant buyer already lined up, Carl. See, we don't wait. And that's a good question because we've been doing this for 20 years. So we made those mistakes. You see, we did that and we realized, oh, you can't wait because you have a moral and a contractual obligation to your homeowner to say you're going to make those payments, right? And then you don't want to foreclose on something that maybe you put some money into it, you know, or something like that, right? You don't want to do that. So the proper way to do that, Carl, as soon as you get it under contract and you know that it's a good deal, you haven't closed yet, you haven't got the deal, right? You haven't got the deed, but you are allowed with the contracts that we give you, you're allowed to market that property to tenant buyers. That's what we do immediately. So by the time I'm closing this, let's say this April 8th, me and the homeowner sign, and we're going to close on May the 8th, right? 30 days from now, just use that, right? Guess what? Between now and May the 8th, I have a bunch of tenant buyers that I already marketed to who are lined up to see the house, who got the money, qualify everything. So by the time I close with my homeowner, I got a tenant buyer lined up. That's 2 reasons you want to do that, right? Because obviously, like you said, it makes the mortgage payment, right? The other reason, Carl, is that what if you have 6 months of back payments that you got to make up, right? From the homeowner. That's why he's foreclosing. So we teach you, again, we're not taking this money out of our pocket, out of our bank books, out of our debit or credit card to make them back payments. We're not doing that, right? We teach you to get other people's money. Guess whose money you're going to use to make those back payments? Your tenant buyer. We do it all the time. Our tenant buyer has to come up with, it's similar to a down payment. It's called an option fee, right? That money makes up the back payments and the extra money goes into your pocket. That's what we use to cure the default and bring them in. And then we close at the same time, like a double closing with the homeowner and with the tenant buyer, and voila. So now we have mortgage payments made, and now we have back payments made, not out of our pocket, but other people's money. Okay, that's one way we make the back payments. Okay, but that's a very, very good question. It's an intelligent question because obviously, you're thinking and you have to think about that. Well, damn, I get this. What if I get 2 and 3 properties at the same time, right? The same week. Then I got 3 mortgages I got to pay. Well, you start marketing immediately. And let me tell you, Carl, you're going to have people knocking on your door, calling your phones as soon as you get a property, because everybody that I know is looking for a place to move.
Mhm.
Everybody I know is looking for a dwelling. And they said rent to own. I got people on the list right now. I have nothing for them, right? But they're on the list. And I said, as soon as I get something that is up to your qualification, what you're looking for, what city, town, state, speed, amount, bedrooms, and everything, I'm gonna call you. So as soon as I get a property, if it fits the bill of the people on my list, I'm gonna call them right away. I got a potential thing. Now, what happens if me and the homeowner don't close? I just tell my tenant buyer that didn't, property's already gone, didn't work out. Sorry, next I'll keep you on the list. Simple as that. But good question. So I teach you not to wait like these other guys do. And then they got 2 more months of payments to make out of their pocket, or they're coming from the tenant buyer. It's eating up their profit and whatnot. You see what I'm saying?
Mhm.
I hope I answered your question.
Oh, yes, sir. Thank you. Thank you.
Yeah, and that's how you would do that. And we're gonna go into that, Carl, more into depth as we go into different sessions, because each session covers certain questions, answers, and particular things involved with this strategy. And that's one of them. And we're gonna get to that. That doesn't mean you can't ask it now. And I'm glad you did, because that brought out into the open, because that's what this is for. Because we don't want anyone to go into the session thinking, oh, they didn't answer that question. That's gonna be no. Ask it now. Get it out in the open. That's what this Q&A is for, to get those things out. And we're gonna give you the answers, and then we're gonna teach you exactly how to do this. All right, so we appreciate that. Again, like you just did, interrupt me. I don't care. You're not being rude. Because Constance will tell you, everybody will tell you, I tend to ramble on and talk and talk and talk. Just stop me, and I'll be more than happy to answer your question. All right. Thank you for that. Any other questions? Tila, you're back. Just when we thought it was safe.
I actually have a question.
Yes, ma'am.
So you know how like you close it within 30 days?
Mm-hmm.
What if the people that you got the house from want to get it back? Do they have to pay like everyone else?
You can do that. I've had people who do that. Because remember, when you have it on a contract, you haven't closed, right? Which means you don't have the deed, right? But you may be marketing, you may be spending some money for marketing, getting tenant buyers, I don't know. But I've had a couple of times people have changed their mind. Guess what? They had to pay me. I had one person, I told him, said, no, this is under contract. We have to move forward with this. He said, well, I got somebody else who's want to do the deal. I said, well, have them meet me. And they met me at some kind of restaurant in somewhere in Mesa or Tempe, I forgot where it was. And they had to pay me for the contract. $500, give me what's worth to me, $500. That's it. And they had to do that to let it go. Okay. Because I teach you to do another thing. That's a good question. What if the homeowner changes their mind? And sometimes you'll find, good question, Tila, you'll find that the homeowner changes their mind, not because they want the property back, because first of all, they couldn't make the payments anyway. They're going to foreclose, right? We find that people change their mind because someone else came to them, just like us, and offered them some cash. Remember, we don't do the cash thing, right? But what if an investor goes around you after you sign the contract and says, hey, how you doing? I heard you in foreclosure. Oh, well, I already signed with Miss Tila, and she's taking a Miss Tila. How really? Oh, okay. You signed a contract? Yeah. How much did she give you? Oh, nothing. She just helped. Oh, nothing. Oh, I tell you what, we'll give you 5,000. You will? You know what that homeowner is going to do? They're going to sign with that new investor. But we teach you how to protect yourself in case that happens. So we have a document that absolutely protects your contract, and they will not be able to get clear title or sell that house without you releasing it, and you get cash for it. And we'll go into that. That's a real good question, Tila. So I appreciate these questions you guys have, but there's ways around that. And again, if the homeowner wants it back, I look at it this way. If it's too much trouble to keep it, I give it back to them. If I haven't lost any money, you can have it. But now if we get the deed, right, and the deal is done and we close the deal, that's over. It's just like when you buy a house traditionally with the regular method, right? You get a loan, the guy across the street selling the house, you get a realtor, blah, blah, your mortgage company pays it off. You got the deed, you move in. Here comes the homeowner. A couple of weeks later, hey, I know I just sold you the house a couple of weeks, but I changed my mind. Can I get it back? No, you cannot. It's a done deal. You signed the deed over to me and it's done. You sold the house, I bought it. This is the same thing. So you're buying the house in subject to, but you're not buying it with cash. You're buying it with a contract saying that you're taking over the mortgage payments and you're stopping their foreclosure and you're saving their credit. So that's a real good question. And we'll get more in depth with that, Tila, as we get into certain sections that do cover that. But that's an excellent question. But no, if they change their mind, if it's problematic, because Constance will tell you, we've had somebody who did. And I was like, let's move forward with it. And Constance was like, I don't think I don't think you should do that, Eric. This is not going to work out. And I'm like, no. I should have listened to her because it was the problematic thing that messed up a lot of stuff for us. So if you get that inkling, back out of the deal. It's not going to cost you anything. But if you get the deed and you own the house, make them pay for it if you want to give it back. And I've done that to people too. A guy had to meet me somewhere and give me $5,000 for the deed. I'm like, sure, you can have it. Here you go. I only had the house for 2 weeks. You see what I'm saying? I just made $5,000 for 14 days. Boom. It's cash in the bank. That's the way I look at it. Most deals are not going to go that way. Most homeowners are going to go right through with what you said. The reason why, because they can't make those back payments. They don't know how to do what we do. All they know is like, okay, I'm in foreclosure. If I rent it out and become a landlord, that might save my house. No, it won't. If you have 6, 7, 8, 9, 10 back payments of $3,000 each, and you're doing a rental, all you can get is the first month's rent and security. That's not going to cover the back payments. The lender's still going to foreclose. That's what happens to these homeowners, and they fail and they don't make it. They don't know how to do rent to own like how we teach you how to do it, which is lease with option to buy with the tenant buyer. We have the contracts. We know how to do it. We teach you how to do it. We carefully do it, and we make the money. So with that said, I'm going to say this. If I was a homeowner who was in pre-foreclosure, I lost my job. Oh my God, I lost my job. I can't sell the house because it's upside down. I owe more than what it's worth. I'm going to foreclose. I can't make the back payments, can't get the loan. I went to the casino. I didn't win no money. Mom won't lend it to me. It's a disaster. So I would not be walking away and foreclosing. You know what I would do, folks? I would move out of that house, move in with a family member or a friend, and I put my house up for rent to own. Rent to own means I'm going to get an upfront option payment to cover my back payments. So that's going to cure the default. I still own the house now. Then I'm going to put somebody in to rent to own it for me, right? That means they're going to be paying my mortgage. On top of that, what I asked for the rent. Boom. And that's going to save my house. So basically, a homeowner can do what we're doing if they have the knowledge to do this. And most of them do not. And by the time they learn it, guess what? Foreclosure. Sorry, the house is already sold. You see what I'm saying? So again, we're just doing what a homeowner could do, except they don't have the knowledge to do this. They don't have the experience to do this. They don't have the time to learn because time is not on their side right now. Now, after the fact, they're learning about it and say, oh, next to go around when I get a house, this is what I'll do. Okay. So great question. I appreciate that. And that's why I don't mind you guys interrupting and asking questions, because these questions will elicit some of this information that I may not be thinking about, but because you asked the question, now I'm able to partake, this information to you. So thank you for that. We really, really appreciate that. Any other questions, Tila? Hope I didn't.
No.
What about you, Mr.
No,
Carl?
you're fine.
Okay, great. All right, so subject to the existing mortgage. Now, there's a certain appeal to actually acquiring properties subject to the mortgage. What is it? Great appeal to me. You get to acquire without qualifying for a mortgage, right? You get to acquire 1, 2, 3, 4, 10 houses without qualifying for a mortgage. That means your credit is not on the line. You simply take over the former homeowner's loan, right? Okay, and they're still going to retain liability, because if it forecloses, guess what? If it forecloses after you guys take over, let's say you miss a couple of mortgage payments too, and you mess up, and the bank forecloses, even though the deed is in your name, guess who is liable? Not you, the former homeowner. And we give them full disclosure on this. We tell them the whole thing. They understand that, and they legally sign, understand I'm liable if something happens if you don't make it. Okay, so that's a positive for you, because let's say you might have, out of the 20, 30 houses you get, 2 foreclosures, it's not going to be on your credit. It's not going to affect your credit, you see, but it affects the homeowner's credit. So that's how that works. All right, so that's a good thing. Now you're still going to get title and deed to the property, right? The seller is going to be formally liable for the loan. All right, and then some people just like I said earlier, why would a homeowner agree to take over the property subject to the mortgage, right? Why would they just sell it? Because they can't sell it, okay? So this kind of question is usually asked by people who don't understand human side of deal making in real estate, okay? Those of you who just came in, please mute your mic because sometimes we can hear background noise, breathing noise, stuff like that. So if you just logged in, mute your mic. And then if you have a question, unmute it, and then we'll be able to answer your question, okay? Thank you so much. So remember, people don't understand this. When I tell people about this, non-investors and people who don't do this cannot understand the concept. But it's the human side of deal making. It's the human side of deal making. Remember, subject to this strategy, you're not making a deal with the bank, guys. You're not. You're making a deal with the homeowner. Subject to this strategy is a private transaction between you and the homeowner. That's what it is. So most people, they can't comprehend and understand how anyone could ever agree to that. How would anyone give up ownership of their property, but also they're liable for the mortgage if you mess up? Yes, because what's the alternative? Foreclosure. You see, they're between a rock and a hard place. So some people say, well, you're taking advantage of people. No, we're not, because had they not met us, guess what would happen? Foreclosure. You got it? So we actually step in and give people an alternative where none usually existed before. That's why I'm telling you, if I could, I should have videoed a couple of times we went to people's houses. By the time we left and walking out their door, they're giving us hugs. Thank you so much. God must have sent you an angel. They really do this. They thank us, send us emails, everything, invite us to dinner at the new place. They just love it because we have helped people. Now, the beauty about this strategy is not every property you're going to get is going to be behind in payments. The last one we got, they were not behind. They were current. They just didn't want to deal with the property anymore. It was the second property and they didn't want to deal with it. They were elderly people. They had tenants in there. They just didn't want to deal with it. And they saw our website. Oh, you take over? Yes, we do this. Woo, woo. And I asked, you have any questions? Say, no, we went to your website. You answered all our questions on your website. Our only question is, how quick can we do this? That's all they wanted to know. That's all they wanted to know. We took that property and made some good money. I flipped it to an investor for $15,000 because it was just a 1-bedroom house, a small one. $15,000 for the deed. We asked for gold. He gave us gold for the house. See, there's so many, and look, we got it for free. You guys get it? This is a money-making business. I'm gonna teach you how to do this, all right? So remember, subject to is a private transaction between you and the homeowner, not the bank. You will be talking to the bank, but on different terms, and we'll teach you how to do that too, because you're gonna be making the payments. You're gonna be asking them certain things, you're gonna be finding out certain things, and we'll teach you how to do that. So we're gonna have a certain document that we're gonna have the homeowner sign, which is gonna be notarized, giving you the power to talk to the bank as if you signed the mortgage, but you did not, and you're not gonna be liable, but they will answer all your questions, all right? So that's how that works. And there's a number of reasons why people would work with you, you know what I'm saying? Because number one, they tried to sell their house, and if they owe more than what it's worth, they have to come to the closing table with the cash to make up the difference. So if you're 7 months behind, I know you ain't got $10,000 or $20,000 or $30,000 to make up the difference or more. You don't have it, or else you wouldn't be behind in payments. So they can't do it. If they list a house with a realtor needs commission. A realtor is going to look at the deal and say, well, shoot, it's upside down. You can't come to the table with the money. I'm not going to make the money. So realtors turn them down too. Okay. Wholesaler investors are going to turn it down too, because they need a spread. They need to have some cushion in there when they flip that house to someone. If there's no cushion to flip it and it's upside down, they can't do anything either. So who is the last resort? People like us who know how to do these subject to transactions. Okay. That's why. All right. Now, some people learn this technique and they make a grave mistake. They go to regular homeowners, right? Regular homeowners, and they try to, sell them on this subject to deal. And homeowners, they're not going to do it. Why would they do it? When they can sit back, wait for the home to sell, get all their equity. They're not behind in payments. They're not stressed. They're not going to do it. You know why? Because they don't have to. This particular strategy is for what we call motivated sellers. You probably heard that plenty of times. It's overused, but that's what it is. They have to be motivated. What would motivate a person? Anybody want to chime in? What would motivate someone to do this? What kind of situation would they have to happen?
They've exhausted all their options, one, and it's a possibility they could be homeless. The foreclosure date is like next week or 12 days away, and they're scared and they don't know what they're gonna do. Their credit may plummet, and it's probably already plummeted a little because they're already 3 months behind on their mortgage payments or more.
That's right.
So they may not be able to move into a property easily, renting, or especially, you know, when it comes to purchasing a property. So that would motivate them to want to
Right.
have a mortgage relief program or a debt relief program help them, because they don't have any other option. There's no equity in their property. It may need repairs. It may not be able to pass an inspection, or it may be some shortage that that's came up in the past, scarcity. They may not have a garage door that works.
You never
And
know.
it can't pass inspection or something of that nature.
That's
So
right.
that would be, I think, the key motivators.
That's right. So that's what we look for, motivated sellers. If you go to a regular homeowner who's not motivated, it means they don't have an urgent situation. And what's an urgent situation? Emergency, separation, divorce, retirement, right? Behind in payments, job relocation,
Death, sickness.
sickness, all these kind of things. Oh, I got to do this now, you know, and I can't make see, urgent sellers. The regular homeowner is not going to do this. I've had people who learn this strategy and go to another regular homeowner and say, Eric, it didn't work. I said, because that person is not motivated. They don't have to sell to you. They can sell to a regular person and get some money. So they're not going to do this. This is for urgent, motivated homeowners. That's what this is for. Okay. People with, and then there's some people who need to get out from underneath the house, are not behind in payments, right? However, they got to sell the property. What if there's no equity? Okay. What if there's no equity? Right. And they put their property on the market. There's still closing costs that has to be paid.
Is anybody
There's
back
still-
there?
There's still realtor costs that got to be paid, right? That has to come out of their pocket. If there's no equity, they can't do the deal. And most people don't want to sell their house in the regular way and then come out of their pocket on top of that and give the buyer some money and they make nothing. Okay, that's usually how that happens. Okay, so yeah, there's a lot of situations that you know, could come up that qualify for a you know, urgent or motivated seller. You know,
Got it.
I know, it's okay. This is 96, but I was supposed to sign in at 8:26.
remember to mute your
Thank
mic,
you.
Tila.
96.
Okay.
Thank you.
Remember to mute your mic and then unmute it if you have a question, because we could hear you in the background, and we are recording for the purpose of other people who need to watch the video.
I got a quick question.
Yes, sir. Go right ahead.
Okay, so now what if they have equity, you know, like maybe some significant or something, like 100,000 in equity? You know, I know you're saying like, you don't pay anything, you know, but they don't, you know, they want their equity. So how does that work? You carry a note or something, or?
That's a good question. You could do that. You could do that. Nothing wrong with that. That's seller financing. You carry the note for the equity and whatnot. And that's what we would do. So let's say, and we run across that, I've run across that situation. It was a couple who was divorced. And, you know, when you're divorced, you ain't thinking, and none of them was thinking, you know, they actually put the house on the market and they didn't have a lot of equity. If I remember correctly, it was a place called, it was Paradise Valley here in Arizona. And I actually moved to the house, lived there for about 6 months to a year myself. But anyway, they had equity, but since they were not speaking to each other properly, right? They put the house on the market. They had disagreements, this, that, and the other over the amount. And they saw my website and called me and said, hey, you take over mortgage payment, we'll let you take this house. And I came and saw them. It was a black couple and whatnot. Came and saw them, this, that, and the other. And I think at that time, whatever the house value was, I think the equity was like, God, I'm trying to remember. I was in the last downturn, probably was maybe 36,000, maybe 40,000 or something. That was theirs, right? And so they say, look, bro, we know you can do this, where we have confidence in, we heard about you, whatever, but we got some equity. How are we going to do this? I said, well, are you guys going to split what you got? Yeah, we're going to split that. Okay, I'll tell you what, I'll give you your equity. They said, you will? I said, yeah. Because I know they could sell it immediately on the market. But for some reason, they were not talking. They didn't agree with the realtor, something like that. And I said, I'll give you your equity when I sell the house. And they said, you will? I said, yeah. And I said, I'm not going to give it to you when you sign the deed over to me, but I'm going to make a promissory note that we're going to sign, right? And this promissory note is going to have terms on it. The term I did, I said, when I sell the house for the full value and make some money, then I'm going to give you your equity. And they agreed to that. They actually agreed to it. Now you can do it in different ways. Some people say, well, I can't wait, 3, 4, 5 years to sell the house or whatever the case may be. I could have sold that house right away, but see, I intended to move into it. Remember I told you I moved into it? That's why I didn't sell it. Nice house on the mountain, the hill, where we quote unquote can't get in, but I was able to get in. Even the neighbors knocked on the door, thought I was the help, asked me what I'm doing there. I said, I own the house. They said, no, you don't. We're calling the police. I said, no, go ahead. Police came and everything. I said, oh yeah, you really live? Yes, I do. But the bottom line is that I made an agreement, a promissory note to pay their equity when I sell the house. And that's what people like to, oh, we can still get our cash. Yeah. So it depends on the seller, depends on their motivation and their need for cash. But that's what I would do. I would work out terms. Of course, Carl, the terms have to be equitable to you. You see, if they're not equitable to you, I just back away from the deal. I can't pay that. Sorry, it's no deal, no deal. All right, but that's what you would do. You would work out. And in our contract that we go over, which is in session number 4, the actual subject to contract, you'll see there's a space for that when homeowners need cash or need equity out of there. We'll teach you how to do that. So those things are there in case that's part of your deal. What if the homeowner needs money to move or to put their stuff in storage? So you can give them maybe cash at closing. You can do that if you want to do that. So there's certain things in there that will allow you to have a flexible, creative deal if those things like you're talking about do come up. But that's how we would solve that. Now, again, if somebody has $100,000 equity, in my humble opinion, that house needs to be on the market. It would be better that you sold it and tried to get as much as you can and dealing with somebody like me. With 100,000 on there, something wrong, right? You see what I'm saying? And I've had situations like that. I'm glad you brought that up. So we had a couple, they were going to closing, right? They had some equity, wasn't that much, and they couldn't sell the house because the bank who was giving the new buyer the loan required that certain repairs be done to the house. And the homeowners refused to do the repairs. And then the bank refused to give the buyer, right, money to fix the roof, which is like $35,000. See, so they had equity, but they couldn't sell the house because they'd have to come up with $35,000, which probably ate up their equity. And it was a no deal for them. Here I came and saved the day. Hey, I tell you what, I'll take it as is, just the way it is, roof and all, because I can rent to own it as a handyman special. Somebody come in, I know how to do that. The Mexican, I can contract it. They fix up everything. You get them a deal, they'll still get in, they'll make it happen. Okay, I'm not making fun of them, but I'm saying they're out there. They'll take deals like that where it needs a roof, whatever, and I still give them a deal to get in. I still make money, but that's how we would solve that. Okay.
Okay. Also, do you do you train people to get it on a certain, like, for instance, 85 cents on the dollar or something like that? Or is it just?
Good question. I like that question. So, no, we do not. And I'm gonna tell you why. There's a famous guy, look him up. He's been doing this for almost 40 years. He's an old man named Ron, R-O-N LeGrand. You may have heard of him, right? Been around for a long time. He told me, he says, I don't care what they owe on the house. He says, I'm not paying off the mortgage anyway. I'm just making money on the back end, trying to do rent to own. So other investors, if you're doing wholesaling, you have to get it like that. You have to get it 70 cents on the dollar, 50 cents, whatever you can get for that spread.
Brutal
We
ritual.
don't have to do that. We don't have to do that because we're not taking over the property based on equity in there. Okay. Which puts us in a unique position. Okay. because other investors, they're gonna turn away houses that we take, because if there's no room, there's no equity. If they don't get it for 75 cents on the dollar or 60 cents on the dollar, it doesn't make sense to them because they need that room to flip it to make that money for them, right? We don't need to do that because we're not making our money that way. That's why we can take a house that is upside down, all right, with no equity in it and still make money, because we don't care. It could be 100% on the dollar, it doesn't matter, because I'm not selling it right away like an investor would to flip it. That's why he needs that 75% on the dollar. He needs that cushion in between. We're not doing that. So what that does, that puts us in a niche market. I've talked to so many wholesalers at these meet and greets, right? And I talked to them, how you doing? Oh, I was doing pretty good, but everybody's upside down. They owed so much money. There's no room in it, no equity. I had to walk away from the deal. And I said, what? If they knew how to do subject to, they can make money with that property. You see what I'm saying? So we don't have to go by that formula, which is still a good formula, Carl. Don't get me wrong. If you're wholesaling, you want to make sure you get it cheaper, 75 cents on the dollar, 60, because so you have that room spread so you can flip it, right? But in most cases, the people you're going to deal with won't have that room, or else they could sell it on the market. But that's a good question. That's a real good question. But we do have a formula, and the formula is the cost of holding that house and the mortgage has to be less than what you could rent it for, because that's going to be your spread, because that's how we make our money. We make money on the front end. You get that option payment, which I'm telling you is no less than $5 grand. That was back then. Nowadays, with inflation, it's like 10 to 15 grand we ask up front. The last deal we did, you have to give us 15,000 to take the property, to move into it on a rent to own. And then we're going to make $300 to $500 a month on top of the mortgage for the next 3 years. If it's a 3-year lease, 2-year lease, 1-year lease. And then you cash out when you're ready to get that mortgage and your credit is good. So we make money on the front, middle, and back end. We don't have to do that ratio of, X amount on the dollar. We don't have to do that. Okay. Now, if we're fortunate enough to run across a property that does that, praise be to God. That means we got bonuses there. We're going to make some money because I've taken over. I've had people who gave me houses for insane reasons. I'm like, they could have sold this, but they didn't. People got their own reasons. Some people, when they get divorced, it's so traumatic and emotional. They just don't want to have nothing to do with the house. My wife left me, my husband left. I just want out of here. That's what happened to one Filipino lady down here in Phoenix. Are you in Phoenix, Carl?
No, sir. No, I'm out of Chicago
In
area.
Chicago. So you're not familiar with the street, but Baseline Road, she got divorced, right? Her husband deeded her the house through the divorce decree, this, that, and the other, but she was a work-at-home mom. So she was happy. They got the whole house, 5-bedroom, 3-bath, real nice, turnkey, nothing, boo. But she forgot. Shit, I'm a stay-at-home mom. I can't make the payment. So she called me, right? She said, I can't. And they had equity, right? But she was so messed up with the divorce emotionally. She said, look, just take this house, take it. It had equity in it. She even gave me, let me see, this was, I think it was 2000, what was this? Might've been 2004 at the time. So she had a brand new Mitsubishi. That was 2004. She gave me the car too. It was in the garage. So I'm saying you're going to get this. And not only that, she had that oak wood cherry furniture, cherry wood oak furniture in her house. She gave me all of that because she did one. So what I'm saying, you will come across gems. You will come across nice little oysters in this thing. All right. To answer your other question, when you talked about what if you get a property that's, nice, ooh, should I get him some money? Well, one dude, he kept bugging me. He was in Williams, Arizona, 3 hours away from here. Kept bugging me. I didn't want to go. He saw the ad. Hey, I heard you take over. Why you not coming to me? He called me for like 4 or 5 weeks straight. And I finally took 3 hours and a half, drove up there. I said, okay. He said, yeah, I'm ready to go. See, I got my RV here, Eric. I'm ready to go into the sunset. I'm retired. Take over the house, do what you do. I said, yeah. He said, no, sir, you don't understand. And I didn't understand. So I looked at the house. It was beautiful. It had a well on the property. It had solar panels. It was real nice, everything, trees, even had some small structures on the property, right? Other houses, little small things, barns and whatnot. He said, you don't understand. He said, I'm giving you 10 acres. I was like, what? And my mouth dropped. So he gave me the house with 10 acres of land. See, that was a gem. And Carl, I'm gonna tell you, I didn't pay anything for no dollars, no money exchange. He was so happy he could drive off into the sunset. I brought the notary with me. We did the deal, did the deed. He drove off the same day. He was gone. So you're going to get little gems like that. They'll come far and few in between, but you will get those. You will get those. Okay. So I hope I know I was rambling. I forgot what my point was, but I hope I answered your question.
Oh, yeah, you certainly did. Thank you.
Yes, sir. Yes, sir. Yes, sir. So yeah, there's so many benefits to subject to. I love this strategy to death. I mean, I love it to death. This is a way, if you yourself have a blemish on your credit, eviction maybe, foreclosure, bankruptcy, whatever, and you can't get a house traditionally, you can get it just like this. See, I tell people, you can get into the business of getting these houses, making some money on them, or you can just find one that you like and move in, and that's all she wrote. I've taught this to couples. There was one couple here in Arizona. I rented the library in a place called Tempe, Arizona. We were allowed to use the big room and stuff like that. And they came every day, raised their hand, asked questions, raised their hand, asked questions. Ooh, this is back in the day when I was teaching group. And then the class was over after a couple of weeks. I didn't see them. And a year later, I was going through the parking lot of a supermarket. Hey, Mr. Brown. I look, I said, oh, I remember you guys. I said, oh, I'm so sorry. You guys decided not to do the subject to real estate investing. They said, oh, no, Mr. Brown. We followed your directions exactly. We found that 5-bedroom, 3-bath with a pool. We moved right in, make the mortgage payment. Thank you very, very much. Because I found out they had bankruptcy and they couldn't move in. They couldn't qualify. But through my method, they didn't even have to qualify with a bank. They just took over the person's mortgage, made the payments, got the deed moving in, and they owned it. And I think they held on to it and they made like 170,000 when the equity went up because they get it. So that's the benefit of this. You're going to come across something that you personally will like and may want to move in. Or we all have friends. We all have families who need a place to stay. You're going to be the man or the woman, and you're going to be able to, you know, weld whatever you want with these houses for your friends and family. Now, with that said, you know, friends and family, they don't pay, you know, they're the ones that you gotta watch out for. Strangers will pay more than our friends and family will, but that's another story. The bottom line is you'll be in a position to help people if you want to, you know, and you'll have these houses. And another benefit to getting these houses subject to is this. Okay, look, sure, the mortgage is going to be in somebody else's name, right? Now, everyone knows who had a mortgage or still has one or had one in the past, whatever, that when tax time comes, they have something called the mortgage interest, right? You're allowed to claim that mortgage interest on your taxes, right? Guess who claims the mortgage interest? You do. So I've had battles online with these other investors who teach subject to this. And no, Eric, that's not true. According to the IRS, and they pointed out to me, IRS says whoever is the person on the mortgage who signed for that mortgage has the right to the interest payment, which is absolutely true. However, since I do taxes, I had to point out to them, there's also a clause in there. The IRS says also, if the person who pays the mortgage consistently and there's proof that they've been paying it, they have the right to claim that mortgage interest. So that means if you get 10 houses and you get these mortgages and statements coming to your address, guess what? On your tax return legally, you can claim that mortgage interest statement for yourself. Boom, that's one benefit. The other benefit is this. You get the deeds to these houses. This is how I teach you to get it. You get the deeds. That means you're the owner, right? That means the former owner, he can't sell anything. He can't buy nothing. He can't get another loan, can't do nothing because no mortgage company or bank is going to give you a loan against the house unless you can prove that you own it. So you're the new owner now, right? You got 10 of these houses, right? That you own, regardless of what's on the mortgage. You can now go to your favorite institution for lending and say, hey, I need a small loan or a big loan or a mid-sized loan. What's they going to say? The first thing they're going to say, you got any collateral? They always ask us especially, right? We got any collateral, right? Yes, sir, I sure do. Here's one house. Here's the other deed. Remember, this is stuff that you got for free. Here's the other deed, but you own these, right? And they're going to look at this and see, they're going to look at the county recorder's office, see that you own it, and they're going to give you the money that you want because you just gave them some collateral to hold while you get a loan to do what you need to do. This is a benefit here, folks, that is absolutely unimaginable. It's crazy, right? And you didn't have to put your money on the line for that mortgage. You didn't have to put your credit on the line. You see what I'm saying? And then if you have a tenant buyer who's paying rent in the house, the bank is really going to give it to you. They're really going to give you some money because now if you default, they have a cash flowing house that they can collect the rents from. So they'll do something called an assignment of rents. that if you default on the loan that they're going to give you for these houses that you put up, this collateral, they're allowed to collect the rents, and they love that. So it's a benefit to you. So many ways you can make money with this. I'm trying to tell you, without using your FICO score. You're never going to have your FICO score in the
I
loan.
know you expected to be here at the end of the week, and here you are. Congratulations! And how do you feel? Mission accomplished.
Yes,
But that's a good question, you know. But that's exactly how that works. All right. Thank you for that. I think you asked the question, right, Carl? I'm getting a little old, man, so I'll be forgetting stuff, you know. So please forgive me.
That's all
But I
good.
know this subject too, and I love this. I love this strategy. Again, I'm not a Johnny come lately, nor is Constance. And Constance, let me tell you about her. How I met her. She was one of my tenants in a subject to property that I took over and sold to my son. And he was in New York. And he said, Dad, you're in Arizona. I can't. So I knocked on the door, and there she was, her and her family, right? So she was our tenant. She was paying, and then she ended up being an employee for the business. So she learned the business back then, and then she ended up being married to me. Now she's my wife, still in the business, but she can tell you a lot of things that I can tell you. So she's just as qualified. Just want to let everybody know here, she's just as qualified. When you ask her questions, she'll be able to tell you the same thing I will do, and even elaborate a little bit more because I forget things, okay? But this is a great, great strategy, especially for us, because traditionally our credit is kind of salty, right? You know, for real estate investing to us, we think we got to go get a loan. We got to have some money in the bank. And that's a good way to do it too, if you have that. But what if you don't? This strategy allows you to get properties without putting your cash or credit on the line legally. And I've tested it over and over and over and over and over and over again. Okay. And hopefully we made all the mistakes, but maybe there's more to come. But we made so many mistakes that we not only can show you what to do, but we can steer you against, oh, don't go that way, because that's what's going to happen. I think that's a benefit when you learn from somebody as well. Okay.
Eric, I wanted to add something.
Yes, ma'am. Go right ahead.
Sometimes people will call you up on the phone and they're not the typical motivated seller. We had one property that it was in Colorado, and this little boy, he inherited a property from his grandmother, and he didn't want it. And I guess he was like abused in the house or whatever, and they thought the house was spooky anyway. And it did look kind of spooky, I give it to him. And he said, I don't want it. He said, I don't want it. How fast can you get the paperwork to me? I just want it off my hands. So sometimes you'll run into that. And then there's a story I always tell. Eric's going to laugh, but there were some people, they built a log cabin in Minnesota.
Yeah, I'm going to
Beautiful log cabin. They had horses. They had little jungle gyms and stuff for their kids in the back. It was beautiful, but they felt like it was haunted. And so they kept calling me on the phone, and I thought they were pranking at first. And then I guess one day I was bored and I just sat there and not really listened to them. And then I just gave them the spiel, and they was ready to turn their property over. But, you know, they had said that it was haunted so much, we had a hard time trying to find tenant buyers for the property. So like, I think we were stuck with the payments for like 3 months, and then we had paid the back payments. And eventually I called the pastors in the area, and I start calling the churches and stuff like that. And we moved some Christians in the property. So to make a long story short, you never know what you might get. Life is like a box of chocolates, just like Forrest Gump used to say. You never know what you're going to get. So just sit on the phone and listen to what they have to say. Effective listening skills is really important in this business, because you never know what can happen. Another thing too is like people get bankruptcies, or they don't know why the foreclosure never went through. So if you're in a situation where you're talking to someone like that on the phone, a lot of times the reason why the bank hasn't done a foreclosure is because they can't. And you'll end up with a zombie house.
Which is in your
right, which is a free house.
Free.
And that happens too. And there's going to be a lot of free houses now because of the banks going out of business. So since the banks are crashing and they're trying to get bailed out, but some of them are honestly just going to turn their loans over to other banks. In that process, the documentation gets lost, even though we do things by computer. Sometimes the signatures, when we use the electronic pads for signatures, the signatures don't show up. So if you apply, you get a QWR from the lender, and we'll talk to you about that later, but you get a QWR for the lender, they have to give you the documentation, all the documentation, on that mortgage. Even the transfer documents, when they transfer from one institution to the next. So however, if you're sitting there and you're looking and you don't see any signatures, that's a zombie house. So you can just ask them to release the lien because they don't have any right or any documentation to foreclose on the property. And Eric can tell you more about that.
That's right. So I'm sure most of us here, I think old enough to remember the last one, 2008, when it happened, right? A lot of banks and mortgage companies went out of business. Remember, they went out of business. Bank of America took over one of them. What was the name of that mortgage company they took over? Very, very popular. God, if anybody remembers that one. Trying to remember the name. Anyway, this particular bank, Countrywide. Oh my God, I loved every house, every property that a homeowner gave me that had Countrywide. My heart jumped for joy because I knew we were going to get the house for free, or it was going to be a deal made. The reason why, Countrywide gave out so many bad loans, and Bank of America bought these loans, bad or good. And there was such a huge amount of foreclosures during that big era, so many, that the banks were rushing signatures. There were signatures that Constance said were not even done, assignments that weren't done properly, weren't done at all, this, that, and the other. So a lot of these banks, including Bank of America, ended up getting houses that were not even legally signed over to them properly or didn't have no signatures, right? So the law is they didn't even have the right to foreclose. So we found that out. And there was a couple of houses that were in foreclosure, but the bank never foreclosed. 6 months passed, a year passed, 2 years, 3 years, it's still in foreclosure, but they never did it because the bank realized they don't have the proper paperwork, or they should have got the right paperwork and signatures from the former company who closed, right? And they didn't get it. And so this person, they're stressing them about making the payments. And we had to tell the person, look, you don't have to worry about the payments. You know, there's a couple people we told the truth because they were in dire straits. There are other people who said, I just want to walk away. We let them walk away. We took it. And guess what? Free house. Free house. I had a guy who called me. He was trying to get a car loan, and he was in bankruptcy. And of course, in bankruptcy, you have to list everything, your properties, this, that, and the other, and whatnot. And they were supposed to foreclose and take the house. They never did it for whatever reason. I still don't know the reason. They never did it. So he called me and he said, hey, man, I tried to get this car loan and they said, my name is still on this deed. And this was like 3 years ago. I said, really? I said, bank didn't foreclose? He said, no. I said, okay, sign the deed over to me. I'll get it out your name. He said, you will? And I can get it out there because once he signed it over to me, the deed is out of his name. So I said, sign it over to me and also give me power of attorney so I can contact your bank. And any mail they give you, just don't open it, just forward it to me because I knew what was going to happen. I knew what was going on, right? So they forwarded to me, and then the bank contacted me and said, hey, Mr. Brown, we have no intention of foreclosing because they couldn't. That's why it was still sitting there. And they said, matter of fact, we just issued a release of the lien. I said, what? Yeah, we just issued a release like it was paid off, right? So they recorded at the county where the property was at, that the lien of whatever it was, 100,000, 200, whatever, was released. So I had a house free and clear. Now the house, of course, was sitting there for 3 years, nobody in it, weeds growing up, windows broken out, people took out the copper pipes and whatnot. It was still a piece of property. So I called who? You know those We Buy Houses guys that have those signs? Yeah, I called, it was in Cincinnati. I called them, they gave me, they offered 36,000 for it. I said, yeah, because I got it for free. So you're going to get gems. That's what she's talking about. Those are zombie houses where the bank doesn't want it because they can't foreclose. The homeowner doesn't want it because he gave it up. So it's a zombie house. It's like in the middle. Nobody wants it. It's just sitting there. Those are gems. If you can get a house like that, you got the deed. Guess what? You probably get it free and clear, or little or nothing. You're going to make some money. You'll get these too. The key is making sure you get the deed and ownership. So that way you have position of, you know, negotiation of whatever you're trying to do. Okay. But thank you for that, Constant. I really appreciate that. So yeah, we're just trying to let you know that this subject to strategy is a great strategy. Okay. A great strategy. Now, here's another thing people will ask, well, how do we find these homeowners? Do we have to knock on the door? Do we have to do cold calling? No. Now, these other guys, practitioners of subject to, they're going to get a list. They're going to knock on the door, bother homeowners. They're going to buy a list from PropStream and all these other people that they sold thousands of times over to other investors. So you got the same people calling and use, lists and whatnot. But what we advocate is marketing yourself so people know who you are and what you do. All right. What we found out is that if we build a website nowadays, when somebody's in trouble, when somebody wants some food and they ain't going to the store, they're going to go ahead and make it get delivered. If you need a plumber, you're going to go online and find it. If you need an electrician, bottom line, if you need a lawyer, bottom line, anything you need, now you go online to find your source of redress, right? So the same thing in foreclosure. These homeowners go online and look, I help with fee for stop my whatever. And if they find your website, which they will, if you market it properly, that's how they found us. Our phones didn't stop ringing during those times, right? They called us because remember, when someone's in foreclosure, it's an embarrassing situation. So they're not advertising it, not even to their neighbors. They kind of keeping it quiet, but they're online looking for help. So we advocate and practice direct marketing to homeowners and have them call us or you. So it's a direct marketing. You mean you're knocking on the, no, we're not knocking on doors. No, we're not doing that. We have our website up explaining what we do. And when people find us, it tells exactly what our phone number is, what our proposition is, how does things work. We have a Q&A on there. Call and said, look, I'm ready to do this deal. I'll show you your website. Boom. That's how we do it. So you don't have to do any cold calling. You don't have to do any knocking on doors like these other guys do. What if you're new? That's the first thing that turns away a newbie. I got a cold call and explain to people and sell myself. No, you do not have to do it. If people see your website with this information and it's properly structured, they're going to call you. And if they don't call you, guess what I say? Praise be to God. That means they're not the ones. So you're not wasting your time. If they do call you, praise be to God again, because boom, they're halfway sold. You don't have to sell the whole thing. You already know. They just asking you some particular things. How fast can I do it? This, that, and the other, boom, and it's a done deal. All right. So this is how we do this, because the dynamics, but you got to do a little negotiation with them and whatnot. But the dynamics of the negotiation are substantially altered when sellers call you. Okay. Because when that happens, you're going to be in a position to ask questions about their property, their situation, their loan, and so forth. And you're going to be easily able to obtain the information that would normally not be disclosed in a conventional transaction. In a regular transaction, you're not going to get that information. The seller's just going to say, look, you got your loan, you're qualified, just get my money and buy the house, you see? But with this situation, you're going to get a substantial, large amount of information that you normally would not get, because now you are in a negotiating position. The homeowner's between a rock and a hard place, all right? That's how it works. And then, all you got to do is determine if you're interested in the property as an investor is trying to get it. And if the numbers work, and then you quickly ascertain whether the homeowner is going to be a good candidate for this subject to transaction, but like I said, by asking some probing questions to their personal situation, and then boom, motivated seller. Okay. Remember, we advocate that you look for motivated sellers. All right. Motivated sellers are those with a high need, not a minimum need, but a high need to get rid of their property quickly, because there may be a sale date coming, or maybe they got to move out of state to keep their job with their corporation and they can't sell the property. They don't want to wait, or they cannot wait for a traditional or conventional sale because of conditions. They may have a foreclosure date looming. Like I said, got to move to a new city, job location, divorce, job loss, unemployment. Their patience, time, and money runs out. And gradually they become more receptive to this type of alternative option, which may not be ideal, but still serve their need to dispose of the property quickly, subject to. So everybody get that? All right, now I'm open the floor for some questions. I hope you have some questions. If not, hey, we're gonna close out, because I don't want to keep this too long. It's only supposed to be an hour class, but this is a basic Q&A. A lot of people that are supposed to be on this session here couldn't make it. They already messaged me this. They paid for the course, already messaged me and everything. But again, we recorded this so they can watch the video. So I'm certain that the next session will get more questions, this, that, and the other. But we're always going to record this for the benefit of you guys who can't make it, in case you did miss it. But this is an educational thing that we're doing. We're trying to get you up to speed. When you learn this skill, you're going to be in business. This is going to be a business. And remember, we teach you to do due diligence, which means you got to look up to see if the homeowner is really who they are, they're on the deed, what they owe, this, that, and the other. the homeowner is going to do their due diligence too. Because remember, if they're going to give you the keys and the deed, they're going to look you up. So we teach you to look like a business. Have an LLC because they can see if it's public record who you are, right? Have an LLC. Make sure you have a physical address. Make sure you have an email address, a phone number, a website saying what you do, all those kind of things, because it makes a big impression. It makes a difference on homeowners. Back in the day, I used to run across guys with just a plain shirt on and some jeans on with a clipboard knocking on the doors. And people would do that. They're not doing that nowadays. Nowadays, you need to show that you are in business and you have a certain, business acumen, which means give them your business card. They can pull up your website, see what you do, see that you're registered, see your LLC, see you got a phone number, email address, this, that, and the other, because they're going to do it too. Because guess what? If I'm assigning the keys, the deed and give somebody the keys, I'm going to do the same thing. So that's another thing you have to do. This is a business, folks. This is a business. And it does have very good tax implications for you too. Depreciation, you can write off stuff. It's a good business. All right. So we're going to teach you how to do that. And the next session is going to be session number 2. We're going to start off with a little bit more Q&A, a little bit more questions, and we're going to get right into the meat of things, which is marketing. Very, very important. How do you actually market to these people? I want to teach you how to do that and teach you so that they call you, you don't knock on doors, and that you don't call them. All right. Now, if you want to do that, there's some guys, we're pretty good telemarketers. We can get on and we can do the damn thing, whatever, but you don't have to do that. You don't have to do that. All right. So we're going to teach you how to do that. So I want to open the floor for anybody who has any questions, any comments, any concerns. Whitney, how you doing? Are you still with us? Matter of fact, I haven't heard from
I'm
you.
right here.
How you doing?
I'm doing good. I do have a question.
Yes, ma'am.
So if we get to the point, as far as they give us the deed, we good to go. We got all these houses. How you gonna make the payments?
Oh, that's because you came in late. We covered that earlier. We did a whole 45 minutes on that one. However, so I'm going to tell you 2 things. I'm going to tell you how we're going to do it again briefly. And I'm going to tell you to watch the beginning of this video because we covered it. And then we're going to cover that extensively in the next 2 sessions again. We're going to talk about marketing, how you make the payment, because that's very important. We teach you not to make the payments out of your bank book and out of your pocket. No friggin' way. We don't do that. The other guys do. They go to the homeowner, offer them cash. We don't do that. They go to homeowner and make the back payments out of the bank book. We don't do that. So we teach you how to get that money. And as Constance will tell you, there's 3 primary ways that we make up the back payments, and none of them involve your bank book at all. All right. And in my humble opinion, you're going to make the decision whether it's a good deal or not. So if those 3 ways don't pan out, you know what I say? Sorry, sir, we just can't do the deal. Your house is not going to qualify for our mortgage relief program. That's what I tell them. Right, Constance? Doesn't qualify. All right. If these 3 ways that we're going to talk about next time that you can make up these back payments, if that does not work, then we're just not going to do it because I'm not coming out of my pocket. That's just how I teach it. And you shouldn't either. So that's a good question. And I really appreciate that. And I don't want you going broke trying to make up these payments because let me tell you, we did that. That's right. We did that. Mistakenly thinking that we had it going on. There was some properties that we were paying $1,400 a month for 3, 4, 5 months, and it was coming out and it was ridiculous. So we learned not to do that. So we're going to make sure that you don't go down that road and waste your money and make those kind of mistakes. You do not make the mortgage payments out of your pocket. You do not make up the back payments out of your bank book or your pocket, or you don't, or do that either. Okay. That's a good question. Thank you, Whitney. I appreciate that. Any other questions? Come on with it. Come on with the questions. This is question and answer time. Let's make it happen. All right, Mr. Carl, any other questions, sir, you have for us? Are you pretty good?
Yeah, I don't want to take up too much time.
No, you're supposed to take up time. That's what this is for. It don't, everybody says that. I don't want to take it. Come on with it. I love the questions. Let's get it out there.
I guess I was just I just want to know, like, what are some of the seller's concerns, when you bring up the way we take over stuff, like what would be some of their main concerns? Like,
That's a very, very good question. Let me tell you what the number one main concern is. How do I know you're gonna make them payments? That's the number one concern. Number one, how do I know? Yeah, I see you in business. I look you up, did my due diligence. But how do I know you're gonna make the payment? So there's a couple things that you can do. And we'll talk about that too. Primarily, one amongst them is that there are companies who will be like a go-between, right? That you can make the payments to them, right? They're official companies, title companies, they do this all the time, and they'll make the payments. So they'll ensure for our client that they are a non-interested third party, that their job is to make sure payments are being made. And we make it to them, and they make it to the mortgage company. And the homeowner can always check. That's one way. A lot of times we never have to do that, because this is what I tell the homeowner. I said, look, you're still on the mortgage. Yeah. Your name is not coming off there. That means you can call the mortgage company anytime you want, no matter how long I have this house, and see if Mr. Brown made if I made the payments, if I miss a payment, if I'm late. So you're going to be able to check and see what's going on at all time, at any time. And I say, it would not be good for me in my business if I didn't make the payments that I said I was going to do. First of all, that would mess up my character, my reputation, my business, everything. And I wouldn't want that to happen. Not only that, when I take your house, unbeknownst to them, how I make my money, they don't know, but I'm going to tell them, when I take your house, I'm going to put time, money, and effort into it. So if I don't make the payments and it does foreclose while I have it, I lose out too. And technically I do. You see what I'm saying? So that's what we tell them. So the thing is, one thing we're going to teach you here, we're not just going to teach you this theory of subject to, how to do it, and give you the documents to say move on. We want to teach you and show you to the point when we go through these documents, you may get a little bored because we actually go through them, because we want you to understand what you have. Because we know one thing, that you may get a homeowner who's going to say, well, I'm ready to sign, but what does this mean in this contract? So we teach you everything to the point that you should be confident enough if they ask you a question, right, that you can respond so confidently that they're going to be like, yes. Well, but if you're like, well, I'm not sure, let me get back to you. They're not going to sign with you. They're not even sure you're going to make the payments. You see what I'm saying? So we're going to teach you to be confident. The same confidence I'm exuding now is the same type of confidence we're going to teach you to get with your homeowner. And remember one thing, in this business, the homeowner pretty much knows nothing. Most of them, this is their first time in foreclosure. They don't even know a lot about their mortgages. A lot of times when we take it over, I look at their mortgage, that they signed, and I point out the due on sale. What, they didn't know about? So they're going to look at you as the expert, first of all. So the ball is going to be in your court. So you're going to learn to utilize that and exude confidence with the homeowner. So we're going to teach you and train you with the documents that we have to a degree that if they ask you any question, you're going to be able to answer it, because we're going to go over these documents with you the same way. We're going to grill you the same way as if a homeowner would. Now, with that saying, I'm going to say one more thing. If anybody bought a house, you remember when you close, the closing documents were this thick, right? Did you read everything? No, you did not. The title company just flipped over and said, sign here. Oh, okay, flipped over. What is it? Oh, that means blah, blah, sign here. That's what so the homeowners are used to that. They're used to the same procedure. So I'm telling you, by our experience, we experience the same thing. When we have our closing documents, which is not as thick, they're going to be like, sign here, oh, sign here, sign here. Because we're going to answer their questions way ahead of this thing. So by the time we get to the closing, that's all they're going to do. Now, with that said, there will be some homeowners who like to read. And they go, look, I looked at the contract, Mr. Brown, and it says here in section 5, this, what does this mean? And I'll be able to rattle off. Now, what does this mean? And they impress, because they're going to test you like that. And when they see that you can talk with confidence and explain exactly what you are giving to them, they're going to sign with you. That's what they want. They want you to exude that confidence. And to them, that carries a long way, because they say, if you know this like this, I know you're going to make the payments. You see what I'm saying? So that would be a concern. A number one concern, Carl, was, are you going to make the payments? And your confidence during the whole transaction is going to help, ease those concerns that they have. It's very, very important. But if you're shaky, you're stumbling, you're stuttering, that, they're not going to have confidence you're going to make those payments, because I ain't got confidence you can explain what you got in front of me. So this is why this is not a fly-by-night course. This is not a get-rich-quick scheme. It's not like the ones on YouTube where they say, we can teach you subject to in 48 hours. We can teach you in 7 days. We cannot do that. There's no way. It takes a month for us to teach you, because we have the real stuff, and we go through this with you by so much lengths. We go through it with you because we want you to understand what you got, because we know that you got to exude that same confidence and understanding of the documents over to that homeowner. Very, very important. And that's what we're going to convey to you. So we don't just give it to you and say, here, give us the money. We're going to teach you everything about the contract. We're going to show you how to do a trust. We're going to show you how to write a deed. We're going to show you how to do all these things that you normally would have to go to some kind of outside learning. I have a daughter who's a realtor. I have a son who's a realtor. They know about Subject to. They both gave me their manuals. One is from Arizona, one is from New York. Both manuals say, yeah, Subject to is possible. It can be done. Did you know they don't teach realtors how to do Subject to? They got to get licensed and they got to go through classes to get their license. They don't teach them how to do it. To learn this, what I'm teaching you, you got to go to people like me, an outside source, to learn it, even for realtors. But they mention it in their books. Yes, it can be done, but they don't teach them how to do it. So this is really good knowledge. And guess what? If you learn it here, you can move to any state and do it. Oh, that's another thing. So you're going to find that people are going to call you from all states. Once you put your business online, they're going to call you. And you're going to say, well, how am I going to take care of this property in California, Florida? I'm here in Arizona. Guess what? We didn't know either, but we learned how to do that. And we're going to teach you how to do it too. It's not as hard as you think. So with that said, I'm just trying to let you know, overall, this is a great strategy. You just need to hold tight, be patient, and we'll give you everything that you need to piece it together. Now, we don't expect you to learn it all in all these 14 sessions. That's why we allow you to take it over if you need for the next session. Again, next 14 over. I have some people who took it 7 times. I don't charge them 7 times. You only get charged once, but you take as many as you need because we want you to learn this. We're genuinely interested in you becoming successful because we want you to be part of our network because we're going to help each other make some money here. This is throwing the line over and pulling you over. It's not us making money and say, see you later. We're sharing this. That's what we're trying to do. And we're trying to help you make money. And one thing we learned, Constance and I learned, no man or woman is an island. You can no longer do this business by yourself. You're going to need help. So you're our help and we're your help, and we're going to help each other make some money in this business. And that's what we tend to do, regardless of your race or creed or color or class or ethnicity. But I'm going to say one thing. Most of us of color, we don't know how to do this. And they don't teach us this. So that's why I'm doing it. They tried to shut me down in Phoenix teaching this. Yeah. They tried to shut me down. They came to me.
Eric.
Know who they are in Paradise Valley, Scottsdale. And they asked me, why are you teaching this to the people, man? Just keep it these, because they didn't want it to get out. They want people to go get traditional mortgage, put their credit on the line. Plus, they didn't want them in the game like they were doing. They were getting these $1 million homes in Scottsdale, Paradise Valley, all these places, and they didn't want me to teach it. But we believe this knowledge should be shared, and that's what we're doing. Of course, we charge for it because time, money, effort, all experience is valuable, and people inherently value something more when they have to pay for it when you give it to them free, because I've given free and I've seen people do nothing with it. But I realize those who pay something, they hold some value and then make some money with it. And that's what we want you. It's a business. We want you to make money. You will make money. I've taught people who have it sitting on their shelf doing nothing. I taught some people, an Italian couple, they went to the moon. They got hundreds of houses. And when I tell you hundreds, they outdid us by tenfold. They appreciate us so much. They invite us to dinner every single month. Come up by the house. We're so thankful. If it wasn't for you, we'd be destitute, because they learned how to do this and they were just dumbfounded. Oh my God, this is so easy. And it is. On the outset, it's going to seem complicated, folks. It is. New knowledge, new documents, stuff you don't know. So yeah, it's going to learning curve. But once you get it, it's going to be a breeze and you're going to make some money. That's all I'm going to tell you. It's going to make money. Now, with that said, this is just one strategy. If you're already a real estate investor, put it underneath your belt. Because I've talked to people who are wholesalers, and I said, you're missing out on money if you don't learn this strategy. That way you can cover all your bases. You see what I'm saying? So with that said, I can keep talking, folks. That's what I do.
Okay.
I love this.
Eric, I wanted to make another
Go ahead.
point
Yes, ma'am.
to camelback off of Carl's question.
Yes.
The second question that I used to get all the time is what if someone slips and fall in front of the property? Who's going to take care of the lawn and the upkeep of the property? There's a few times I ended up getting properties with septic tanks and wells, and they wanted to know if we were the ones that were going to be responsible for the treatment services that, you know, that came with that. The septic tank, I will never do that again. I did that 3 times. I will never do that again. So you just have to find out what their concerns are. Everybody's concerns are different. There was a situation where they were building a freeway in the area and there was a lady, she was worried about encroachment. So there's going to be different people worried about different things. Then there's different people, you know, everyone has different priorities and different thoughts that run through their minds, but usually it's the upkeep of the property
That's right. Upkeep and the mortgage payments. And a
and the
good-
mortgage payments.
to close, thank you, Constance. That's a very, very good point you make. And a good way to close the deal is I say, guess what? You know, you don't have to worry about insurance. You don't have to worry about maintenance. You don't have to worry about repairs ever again. So even if the mortgage is in my name, that's right. You know, that's our responsibility. We're going to take care of that because we passed that on to our tenant buyer in the first place. Okay. Thank you, Constance. I appreciate that. All right, Mr. James, how you doing today?
I'm doing good.
Any questions, concerns, comments?
Not this time, but thank you.
Okay, good, good deal. Zarni, how you doing? You good? Zarni is our agent, our
Yes,
Asian
I'm good, thank you.
student here. He's in California and he has a lot of questions. I think he's gonna take off with this. He's gonna do well. He does the one-on-ones with us on Zoom a lot and whatnot. He's gonna do I think everybody's gonna do well here. I think
Yeah,
everybody's gonna
next
do
week,
well.
next week, when Monday, I have an appointment, you know, for the Orange County office to sneak under the list.
So you went down there?
Yeah, you know, our Orange County and LA County need the appointment,
Mhm.
you know, to get the county recorder office.
Okay.
So sometimes it take time.
Right. So what is Ani talking about, folks, is that I teach you also to get bona fide leads, right? Without buying them, you get them free. Every county recorder's office records defaulted mortgages before they foreclose. The first 3 months they're listed, boom, 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 boom. Then there's a sale date 3 months later. I teach you to log into the county recorder's office where you're at and get those lists, write them down and send the people's letters directly to your website and wait, and they will call you. So we had a one-on-one with Zarni, and I think we went to maybe 5 counties in California, and they don't allow like how we do here. We can find that stuff. So we called them, and every one of them said the same thing. Well, you can make an appointment and come down and get the list yourself using our computers, but we don't allow you to cull that information online. Fortunately for us in Arizona, we can pull that stuff online from the comfort of our own homes. And that's what Zarni's talking about. He had to make an appointment. Am I correct? For the county?
Yeah,
recorder's
yeah.
office? Right.
Yeah, Mandy, you know, I gonna go down to the Orange County and I have a look on the list.
Mhm.
And I don't think I need to write down, you know, I may take a photo or something like that.
Yeah.
Or, you know,
Yeah, you can snap pictures of the list or the names and the addresses and whatnot, but they're there. And those are bona fide leads, folks. See, what happens is that,
it's not useful for now, right?
huh?
Me, the leads, when I get the leads, but those are not useful for the marketing at the moment. I mean, timing.
Well, when you get the leads, it depends because what happens, it depends on how old the lead is. Because this is how it works. If you have a house and you're making your mortgage payments on time, everything is good. If you miss that first month's payment, you're going to get noticed you're late. You miss the second month's payment, the mortgage company's going to be, hey, you know, you missed your second payment. When you do your third payment, they're going to be like, hey, you know, you're in danger of going into what we call pre-foreclosure. When you miss that third payment and you're coming to your fourth, they are formally going to announce that you are in default. And by law, they have to record that default at the county recorder's office. So that's what I teach people to do. Find those 3 months defaults. Because guess what? You have 3 more months before the sale date. Because if you find somebody that's 3 months behind, let's say it's February, it's like it is now April 8th, May, June, July. So that means their sale date is July the 8th or August the 8th. You still have 3 months, you see, to cure that or to work with the homeowner. So that's what we do. And that's how you find these bona fide leads. These people are really.
Yeah.
Yes,
So
sir.
what I'm talking to you is if we even get the list, it's not a good time according to the terms of the economy of the United States, or even we do the marketing to the homeowner, you know, it's not work at the moment, right?
Yeah, it will work at the moment. It depends on the homeowner. It depends on the level of motivation.
Okay.
Because I've talked to some homeowners, right? And they're like, well, yeah, I'm behind, but you know, mom is going to give me the loan, or I got this deal coming up where I'm going to get the money. Then you got some people say, hey, I have no redress. Can you help me? So it depends on the level of the level of motivation of the homeowner,
So
what position that they're in.
even from now on, it's working. So we can
Oh, it
start.
works now. Yeah, people get subject to deals right now. Right
Okay.
now.
That's what I'm talking. Yeah.
Yeah, and these people didn't know that we do this had we not sent out the postcards and letters that we get from the county recorder's office. Like, what? I didn't know you did. I have some people that foreclosed already and called me and said, oh my God, if I knew that you would do this, I would have turned my house over to you, then voluntarily foreclosed. Some people know about it, some people don't. So the level of motivation is going to determine if they're ready to do this. So yes, Arnie, to answer your question, use the county recorder's office because you're going to find 3 out of 10 that's ready to make the deal now. The other ones are still going to have their heads in the sand, waiting for a loan, waiting for, you know, some miracle to happen where they get out of foreclosure. Generally never happens. Okay.
Okay.
Never happens.
Right.
My
Thank you.
favorites are the people that their foreclosure date is like 2 weeks away. Because if their foreclosure date is like 2 weeks away, they're sweating. They're worried. 9 times out of 10, they've exhausted all their options. And they only got 2 weeks or a week to do whatever it is they need to do. And I know that I can stop their foreclosure in 2 weeks. That's a breeze. In 1 week, I know what to do to stop their foreclosure. So they're the ones that you really want, because by the time they get down to, because they're down to the wire, they're sweating. That's like a dude that's like, he got 2 days and he getting an electric chair. And he's sitting there sweating, he nervous, don't know what to do, can't hardly eat, can't hardly sleep. Those are the people that, you know, you really want to get in contact with, because they only have, you know what I'm saying, they only have 2 weeks. They only got 2 weeks, they don't have a plan. You know, they exhausted all their options. Other investors didn't want their property for whatever reason. We acquired a property that was on the side of a mountain, and it was mudslides all the time. And it was in California, and it was mudslides all the time around that property. And so like they had a hard time trying to find an investor to take over that property, and they knew what subject to was. They just couldn't find anyone that would take it. And needless to say, we took over their property. That ended up being a handyman special too. Yeah, so you have to look and see what their need is, and you got to get them just before the wire. You got to get them, you got to get that motivated seller when, you know, they looking at the electric chair, like they cell block is like four blocks down from the electric chair. So, you know, you got to get them while they're sweating. You can't, you know, like arbitrarily just go out and say, okay, this person got 3 months and it's the beginning of the 3 months. Send a letter to them, see if they'll contact you, and then send another letter that's 2 weeks or 3 weeks or even 1 week before their foreclosure date, because you have enough time to stop it. And we'll teach you how to stop those foreclosures fast, because we used to have a business where we stopped foreclosures in 24 hours. So you can stop their foreclosures. You just gotta, you know, you just gotta do your due diligence, and you're gonna send more than one letter out. If you want to start out in the beginning when they first get, you know, on the foreclosure list, that's cool. But make sure you're sending out another letter right then, right before their foreclosure date, like 2 weeks, 1 week. You're gonna send more letters the closer it gets to their foreclosure date.
That's right. Thank you very much for that information and comment, Constance. She's very, very right. And so to answer your question again, Zarni, yes, there are motivated sellers. You just got to go through there and see who's gonna bite. Simple as that. Some may be motivated than others, as Constance said, and some may not be. Some are gonna wait. Let me wait to the 3rd month, 4th month, the 5th month. Some people are proactive. I had some people miss one payment and they call, hey, shit, can you do something? You see what I'm saying? Now remember, if you wait till it's down to the wire, like 2 weeks, 3 weeks before the sale, that means you have at least 6 or 7 months of back payments to get made up. Even though it's not coming out of your pocket, but it's coming from somewhere, that means there's more money that has to be used to make up those back payments. So that's the caveat to that. But it's very possible, as Constance said, because there's ways to actually stop a foreclosure in its tracks.
Right,
remember,
exactly.
Most lenders don't want to foreclose. They'll listen to you if you have a solution to make this non-performing loan perform again. And that's what we tell them. That's our.
Right.
Mhm.
And you can get a forbearance, you can get a modification on the property because you'll have the power of attorney. The power of attorney, it give you, the statement that you need to speak to the lender. It gives you the authority to speak to the lender about the property. So you can get a modification. I got a forbearance before, it was 18 months. I got one that was 11 months. You can get a forbearance. We didn't have to pay nothing for months. And they put it on in arrears on the end of the loan. So we'll teach you how to do that too, if you're part of the elite club.
That's right. So what we're talking about is marketing a little bit. So we're going to get more in depth into this, you know, how you make the payments, how you get the money, how you market, letters, bandit signs, websites, this, that, and the other. So that's what our next class is going to be primarily about. And we'll show you some live examples that we have as well to give you an idea. And then the third and the fourth session, we're going to get into the meat of everything. We're going to start with the actual contract, show you what it's like, what to do, how to fill it out, how to have the homeowner fill it out, little things on it. You're going to see the contract is made in your favor. These are contracts that are made for you, for your protection. So you're really going to like this. All right. So with that said, I want to thank you guys because time is valuable. It's late. Some people are in a different time zone, maybe 12 midnight where you're at. I don't know, but we don't want to keep you too long, but we do appreciate it. Remember, this is being recorded for your benefit, and you will get a copy of this tomorrow. No, tomorrow's Sunday. So you may get a copy tomorrow, but definitely by Monday, so you can review this. So our next class is going to be Tuesday. Our classes are Tuesday evening, Thursday evening, and Saturday evening. Each evening is a different session till we get to 14. Okay, not fly by night. It's a good course, educational. You're going to learn a lot. You're going to appreciate it. Put it on your belt, make some money.
Good night, everyone.
So with that said, I want to wish everyone good night, peace and blessings. Call us at any time. We're always available. Phone, text.
Except for Sunday. He does not answer the phone for anybody on Sunday.
Yeah, you have to be on fire. Show me a video.
Yeah, you gotta text him a picture and you're on
Sunday.
fire.
Other than that, call any day. We got you. Peace and blessings be unto you, everyone. I'm gonna end this recording and we'll talk to you soon.
All right.